video, I'll show you how Singapore REITs' latest moves could help you earn better returns in 2025, and why the upcoming interest rate cuts might be your golden opportunity to invest. Plus, I'll reveal which REIT sectors are showing the strongest growth potential. Hey friends, welcome back to the channel. I'm Iggy here, and if you're new, I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The investing Iguana was recently ranked 8th in the 2023 Influential Tigers by Tiger Brokers with over 800,000 reads, with over 500 videos and 250,000 watch hours as of September 2024. I'm here to help you make smarter investment decisions. Market Performance Overview. My fellow investors, let's take a moment to appreciate the impressive performance of the FTSE ST-REIT Index. It's been a wild ride, folks, with a 7.15% increase in just 1 month. That's the kind of growth we love to see. And let me tell you, this isn't just a flash in the pan. The trends are indicating a strong bullish run in the sector, and I'm excited to see where it takes us. Now, I know some of you might be thinking, Iggy, what about the S-REIT sector? Well, my friends, it's looking pretty attractive right now. We're seeing a discount of 11% to its fair value, which is like finding a gem on sale. And with an average trailing 12-month yield of 6.42%, it's like getting paid to invest. I mean, who doesn't love that? It's a great time to build or add to your REIT portfolio, if you ask me. Major Q4 transactions. Let me break down a fascinating development in the REIT landscape that's catching everyone's attention. CapitaLand Ascendas, REIT is making some serious strategic moves by expanding its international portfolio with a significant investment in the United States logistics sector. They've just acquired the Somerville Logistics Center for $94.8 million, and this isn't just another property purchase. It's a forward-thinking investment that signals multiple strategic advantages. The Somerville Logistics Center represents more than just a real estate transaction. It's the first green certified logistics property in the REIT's U.S. portfolio, which demonstrates a strong commitment to sustainability, a trend that's becoming increasingly important for investors and corporations alike. By focusing on environmentally certified properties, CapitaLand Ascendas REIT is positioning itself at the forefront of the ESG, environmental, social, and governance investment movement. This investment comes at a particularly interesting time when many companies are reconsidering their global supply chain strategies. The trend of reshoring manufacturing operations back to the United States has been gaining significant momentum, particularly in the wake of pandemic-related disruptions and geopolitical tensions. Logistics centers like Somerville are becoming critical infrastructure for companies looking to create more resilient and localized supply chains. From an investment perspective, this move is particularly clever. The U.S. logistics real estate market has been experiencing robust growth, driven by the continued expansion of e-commerce and the need for more sophisticated distribution networks. By strategically investing in a green certified property, CapitaLand Ascendas, REIT is not just acquiring real estate. They're acquiring a future-proof asset that aligns with emerging corporate sustainability goals and logistics trends. Healthcare sector expansion. Parkway Life. REIT's bold expansion into France marks a game-changing moment with their $111.2 million acquisition of 11 nursing homes. This first step into the European healthcare market adds 850 nursing beds to their portfolio through a smart partnership with Domusvi Group, Europe's third-largest aged care operator. The deal structure looks solid. Domusvi will keep running these facilities under a 12-year lease agreement, giving P-Life REIT a steady income stream while working with a top-tier operator who knows the local market inside and out. The timing couldn't be better for this move into Europe's healthcare sector. With the European senior housing market cooling off in 2023, nursing home deals dropped by 35%. P-Life REIT found a sweet spot to jump in. The bigger picture looks promising too. Europe's home healthcare market is set to hit USD 204.19 billion by 2032, growing at 8.66% each year. This growth rides on a silver wave, with Europe's elderly population expected to reach 130.2 million by 2050. Once this deal wraps up, Plyf REIT will have 75 properties worth $2.4 billion, making them an even stronger player in the healthcare real estate game. Industrial and logistics sector. The industrial sector is going through an exciting transformation in 2024, riding the wave of e-commerce growth that has ballooned into a massive $6 trillion global industry. What makes this particularly interesting is how e-commerce companies need way more warehouse space than traditional retail. We're talking triple the space just to handle all those online orders. The numbers tell an impressive story. E-commerce sales are up 6.7% from last year, hitting record levels we haven't seen since the peak of the pandemic. Looking ahead, this growth train isn't slowing down, with global e-commerce sales expected to hit $8 trillion by 2027, growing at a healthy 7.8% each year. When we zoom in on Fraser's Logistics and Commercial Trust, FLCT, we see a business that's really making the most of these trends. They've managed to boost their revenue by 6.2% to $446.7 million for the year ending September 2024, which is pretty impressive. They've got properties in all the right places: Australia, Germany, the Netherlands, and the UK, and their BBB plus rating from Fitch shows they're rock solid financially. What makes this even more impressive is they're pulling this off despite all the supply chain headaches and shipping delays that can stretch up to 20 days. The big picture looks good too. Right now, about 20.1% of all retail purchases happen online, and that's expected to jump to 22.6% by 2027. Interest rate impact. The impact of interest rates on S-REITs is fascinating and quite significant for Singapore investors. Looking at the historical data, when the Fed starts cutting rates, S-REITs typically see a strong performance boost. We're talking about an average 20.9% return in the 4 quarters following the end of a Fed tightening cycle. This outperforms even global equities, which typically return about 17.3% during the same period. What makes the current situation particularly interesting is that S-REITs are trading at a juicy discount of nearly 20% below their book value, with the sector's price-to-book ratio sitting at around 0.8x compared to its historical average of 1.0x. This undervaluation presents a compelling opportunity for value-focused investors. The numbers get even more interesting when we look at the potential impact of rate cuts on S-REIT's bottom line. For every 100 basis points drop in interest rates, S-REITs could see up to a 2.4% increase in earnings by 2025. This is particularly relevant now, as many S-REITs have been gradually unwinding their interest rate hedges, positioning themselves to benefit from falling rates. The sector is currently offering attractive forward dividend yields of around 6.23%, which is significantly higher than the Singapore 10-year government bond yield of 3.4%. What's particularly encouraging is that S-REITs have maintained healthy balance sheets throughout the high-rate environment, with an average gearing ratio of 38.7%, well below the regulatory limit of 50%, and a robust interest coverage ratio of 3.8 times, indicating strong ability to meet their debt obligations. Investment opportunities by sector and future outlook. Data center REITs in Singapore are emerging as shining stars in the investment landscape. And let me tell you why this excites me as someone who analyzes these trends daily. The explosive growth in digitalization and AI technologies, particularly with tools like Microsoft Copilot becoming mainstream, is creating an unprecedented demand for data center space. Think of it this way. Every time you ask ChatGPT a question or use an AI tool, that computation needs to happen somewhere, and that somewhere is in these data centers. This demand is especially intense in metropolitan areas where power supply is limited, creating a perfect storm of high demand and constrained supply. What makes this even more interesting is that Singapore's position as a regional tech hub puts it right at the heart of this digital transformation. When we look at the broader S-REIT market, we're seeing some fascinating patterns that smart investors should pay attention to. Singapore-based assets have shown remarkable resilience, maintaining stable valuations throughout FY 2023, while some overseas assets have faced challenges due to cap rate expansion. But here's the really exciting part. The sector is showing strong signs of growth potential, backed by improving market sentiment. A perfect example of this confidence is CICT's recent equity raise of $1.1 billion for the Ion Orchard acquisition. This successful fundraising isn't just a one-off event. It's a clear signal that investors see real value in Singapore's REIT market. As someone who's been tracking these markets for years, I can tell you that this combination of stable local assets and strategic growth opportunities creates a compelling case for investors looking to build a robust portfolio in the current market environment. If you found value in this analysis, make sure to hit that like button and subscribe to the Investing Iguana for more in-depth REIT coverage. Don't miss it by hitting that notification bell. Remember, smart investing is about staying informed and making decisions based on solid research. See you in the next video.